Last week, during video 167, I briefly mentioned using net asset value or NAV as one of the final filters in my research process when the final list of funds is longer than normal. I deliberately skipped over the section because the video was already running long, and I didn't want to spend another 10 minutes or so walking through spreadsheets and fund data. But after digging deeper into the final list, I found something that deserves its own conversation. Today isn't about market headlines, inflation, currents, or interest rates. It's about understanding how one fund separated itself from the pack. And the answer starts with NAV. Hello, my name is Daniel Young, and this is Adaptive Perspective. Every week, we celebrate currents from noise and opportunity from fear using an income-focused strategy in closed-end funds. It isn't polished, it's not scripted, and it's definitely not hard thinking. We don't chase headlines, we navigate markets. Now, let me be clear. I am not a financial advisor or fiduciary. I'm an income hunter, a strategist who filters the noise, follows the data, and targets durable cash flow, even when that means taking a different course. So let's step into last week's waters and deep dive the data. So if you've followed this channel for any length of time, you already know I don't look for the best fund. I hunt income through identifying the strongest flowing financial currents. That's step one. Step two is choosing your investment vehicle. I only use closed-end funds. I like the predictable system. Limited shares creates a true supply and demand structure where you can buy funds for discounts, whether real discounts or discounts based on a fund's historical numbers. Step three is tracking the data on the funds and doing the hard work. In step four, I filter the list of targets. I move the targeted funds off into a separate spreadsheet and filter down the list. When every fund on the list is already selling from wider than normal historical levels, you must have a system to further sift the list. I narrow them down based on the flowing financial currents, the dividend yield, the price, and the dividend schedule. But sometimes it's still not enough. When you only have so much money, and there are lots of options on the final list, there's another metric I use to significantly trim the field and identify the real gems. I track a fund's net asset value, or NAV, over the past year and use NAV as the final determinant. NAV simply tells us whether the management is actually creating value over time or simply distributing your money back to you. I completely understand that different rate markets impact funds and financial currents differently, but all funds and all currents still feed off the same market. So while I expect volatility, every fund is still trying to maximize its growth in a pick a rate environment. There we go. In other words, if two funds sit in the same current and pay similar distributions, I'd rather own the fund whose underlying assets have grown during the volatile market and are still growing. And that's where this story gets interesting. When I compared the 1-year NAV performance of the final candidates from last week's video, one fund clearly separated itself from the others. So let's pull up the data and walk through it together, because once you see it, the selection becomes pretty obvious. So let me share my screen and we will get into this. So these are the funds off last week's video. And to find the NAV data is fairly simple. You just go to CEF Connect and then you ticker search every fund. Since IGR sits at the top of the current list, I'm starting with IGR. You can check the distribution schedule and the distributions. IGR pays a fantastically consistent dividend, but their NAV over the last year has gone down. So we can cross it off our list. HGOB. Same thing. We can pull up distribution. They've altered their distribution, but it's still a fairly consistent dividend. and their NAV data has finally risen a little bit. So we can leave it on the list. PHK, right? If we wanted to, yeah, we could look at their dividend. Same thing. NAV data has gone down a little bit. DSL, same thing. We could look at the distribution, but their NAV data has gone down a little bit. PTY, their NAV data has gone down a little bit. That's close to par, but it also looks below the metric from a year ago. PDO, NAV data has gone down a little bit. DLY, NAV data has gone down a little bit. RFI, lots of ups and downs, but their NAV data seems to be a little higher or at least on par. Maybe it's a little higher, maybe it's on par of a year ago. So we'll keep it on the list. So far, out of a final nine, just two funds are on par or slightly better than they were a year ago. And we have PDT. And we see a fund that is significantly different than the rest. NAV data from a year ago, NAV data today, higher. Price, for whatever reason, has dipped. And I wish we could always explain things. I wish there was always a good explanation of things, but sometimes there's not. You have the market in general, you have the general investor, and the terms surrounding the general investor don't apply to you and me. We do research, we dig into things, we try to see a different perspective, we try to see a bigger picture. Most herd investors don't have a strategy. I have a strategy for investing, which is depicted through my videos. You have a strategy for investing. Most herd investors have no strategy. They get their stock tips from the news or online or a friend of theirs, it's by word of mouth. And just like the seagulls in Finding Nemo, who are repetitively saying, my, it's more like they're seeing here, 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 and they're trying to find the gems in the chaos on the surface of the market's chaos. We're different, but the in that, even though closed-end funds is its own niche or niche market, you still have herd investors or newbie investors dabbling in the space. So even in the closed-end fund market space, it's still volatile. It's honestly probably more volatile because it's a smaller space than the broader market. So I can't explain why investors as a whole panic about stuff, but they do. And when that happens, it's important to know as much as you can about what's going on. Yes, but it's not a place you want to get lost in. Like it's not like I have to know, and I'm it's almost like I'm despairing because I don't know what's going on. It's not that. It's recognize what you see what you can see, recognize what you can recognize, And regardless of the fear enveloping the market, don't let the fear guide you. Look at things logically, look for the patterns, find the currents, see what sits inside the currents, and then go from there and just keep sailing. Let them hunt through the chaos and the wreckage. Let them. You do your own thing. So I can't explain the gap between PDT's price and its NAV, nor can I explain why we see the dips in the fund, why we see dips in NAV and the funds that are sitting in the primary flowing current. I can't explain it. I mean, sure, I could find it online. I could Google or DuckDuckGo or pick your search engine or pick your AI bot. Sure, they could give you some form and reason and scheme of why it might be happening, but it's really just the random investor and how they're investing. So I can't explain the gap, but it's not necessarily important that I can explain the gap. The important thing is that we see the gap and we identify it, we identify the value, and then we take action on that. So it's like, oh my gosh, it is different. So yes, I bought PDT. It was the most significant difference displayed in this set of funds. HGB is close, RFI is close. All of them are good picks. But if I really have to sift it down into a fund that I can buy, right? I only have so much money. Most channels focus on what you could do in an infinite market. But the reality is you only have so much money. So do the best you can, do the best you can with your money in this market, in whatever week you're investing, whenever you're buying, right? And it's not necessarily picking the best fund. It's optimizing your money. So I can invest in any of these funds. But this week, the best deal is PDT. So I'll leave you with this. NAV data is a great tool, but NAV should not be your only evaluation metric because sometimes NAV tracks get lost in fast flowing currents or changing currents. And that's why the full system and a consistent application of the system matters more than one single metric. Return viewers know that I use the same step by step framework every single week as I sift the data. I identify flowing financial currents, track the data, look for wider than normal historic or wider than normal discounts, create a target list, and then filter that list based on the following boundaries: currents, price, yields, dividend schedule, and when needed, net asset value. When the list of possibilities is long, NAV is the wild card. Use it when you need it, but don't overplay it. That's all I have for this week. I will see you next Sunday. I wish you a great and successful week. And yeah, I hope that you get stuff done this week. I hope that you use your time well. I hope that you cross some things off that you need to do. Uh, and I wish you success. Have a great week, everybody. I will see y'all on another video. Bye bye.